This video is going to be part 2 to my payroll journal entry video from last month. I just wanted to add some examples to that video. In that video, I went in depth about debits and credits and different accounts that you might see in a payroll journal entry. So I do recommend watching that first. But basically in that video, I just had this example payroll situation. And I created journal entries for that. I have a couple of different options, and this spreadsheet is available on my website. I have each account, the debit, credit, what account category it is, as far as whether it's an expense account or a liability account and so on. And I also gave a description here so you would know where I was pulling these example numbers from. So I just wanted to point this out before I get started. In that video, I basically entered these journal entries in Wave, and then I added a few extra situations in that video. So it's not exactly like this entry, it's this entry plus a few extra things. And then today I'm going to add even more additional situations so I can give you some more examples. I do have more payroll videos planned, so if this is a subject that you need help with, definitely subscribe and watch for those videos. And before I get into the video, I want to review some of the terminology. Debits and credits will be something I talk about a lot. Debits and credits represent increases and decreases to accounts. If you learn this in a textbook, you'll learn that a debit is simply something on the left side of something called a T account, which just looks like a T. And then a credit is something on the right side. So these debits and credits represent increases and decreases, but whether something is an increase on the debit side or an increase on the credit side depends on the type of account. So I have this chart. These are the rules that you would follow for debits and credits. For assets and expenses, your debit side is the increase side. Anytime you add to those accounts, it would be a debit. When you subtract from those accounts, it would be a credit. And then for liabilities, equity, and revenue, it would be the opposite. And then also, I'm going to talk about journal entries. This is just a way to record transactions in your software. You may or may not use journal entries normally, because a lot of times when you're making entries in the software, you're not doing it in a journal entry format. You might be recording a check, and the software records a journal entry or records the debits and credits for you. Or if you do a deposit, the entries are being recorded for you. It just may not look like a journal entry, but the debits and credits are going to follow the same rules, and they're going to be posted behind the scenes. And then this is what a journal entry would look like if you were learning it in a textbook format. But we're going to use Wave apps to actually do the journal entries in this video. So this is where we left off in the last video. First, I want to just briefly talk about this entry. So we have gross wages here as a debit to the salary expense account. Anytime you have an expense, you're adding to the expenses of the business, so you're adding with debits. You increase expenses on the debit side. And then office supplies was a reimbursement. Payroll employer taxes, that would be like the employer's portion of the FICA tax. It would be unemployment tax and things like that that the employer has to pay. The employees had deductions for insurance. They contributed part of the insurance cost, so those would be subtracting from the business's expenses. So these expense accounts are credits. And then there was a 401k contribution of the employees. That's a credit to a liability account to show that those will be paid at some point to the 401k administrator. The net pay is going to be a credit to subtract from the checking account, because that's going to be a deduction from the checking account, and this is an asset account. And then this credit to checking, this subtraction from checking, is going to be for the taxes and withholdings and things like that. And then the garnishment is going to be a garnishment from an employee's paycheck, and then workers' comp insurance is an expense of the business, so that was a debit to that expense account. So this is where I left off last time, and I just want to add some examples. In the first example, I'm going to talk about how to record an owner draw that's part of payroll. So if the owner is paid with payroll along with the other employees, you'll want to make an entry separate from your salaries expense account, because an owner draw is typically going to be posted under some sort of equity account. So if you remember from the journal entry rules, I'll pull those back up. Any equity transactions you add to them, you add to the owner's equity with a credit, and you subtract from owner's equity with a debit. So I'm just going to add a line here. Let's say the owner was paid $2,000 as a draw. You would post it to whatever equity account you normally use for owner draws. In this case, I do have an owner drawings account set up. And it's going to be a debit because if the owner's pulling money out of the business, then it decreases equity. And then it's also going to subtract from the checking account, which is an asset. And if we go back to the rules, once again, assets we subtract from with credits. We already have 2 credits to checking, one for the net pay and one for the taxes and withholdings. This would probably be lumped together with the net pay. So we're just going to change this to 7487 instead of 5487. So we just lumped it together with the net pay that was already being subtracted from the checking account, and now we're also subtracting this $2,000 payment, and we're doing that by posting a credit. And then I did in the other video also talk about guaranteed payments, and sometimes the CPA wants me to, instead of using the equity account, put the owner drawings in a guaranteed payments account. So this would be in the case where the owner gets a set draw, set pay every pay period or every month, or there's some sort of regular payment that is expected. So sometimes the CPA will ask me to put that in an expense account called guaranteed payments. If that were the case, then I would have that as an expense account here instead of drawings as the debit. But I don't see that very often, so you're more than likely going to be using an equity account. Okay, I'm just going to save this and go on to the next example. In the second example, we're going to do a bonus to employees. So we're going to go back to this entry. Now, some companies just put any bonuses they pay to employees right in with the regular wages. So we would just add it here, and then it would be part of gross pay. But some companies like to have a separate expense account for bonuses. They might do that if they want to see how much they're paying in employee bonuses versus how much they're paying in regular salaries and wages. For this example, for this video, I'm going to use a separate bonus expense account. So if the company is paying bonuses, that is going to be an expense. We're adding to an expense, and anytime you add to an expense, that is a debit. So I already have a bonus expense account set up. Let me see if I can scroll down to it so you can see that it is in the expense category. Okay, so here it is under expenses, and it is called bonus expense. Some companies go even further and have separate bonus expense accounts for each category of employees, but I'm not going to do that here. I'm just going to put it all in one bonus account. But some companies might have bonuses for sales staff, bonuses for administrative staff, and so on. They might separate it out. Okay, so let's say the bonuses to employees were $1,000. Now, normally that would get included in wages, and taxes would be calculated on the bonus in addition to the salaries, but I don't want to redo all the taxes at this point, so just know that it would be taxed. But in this case, we're just going to assume that it was already, the taxes are already calculated and include this $1,000 bonus expense, and that is going to also increase the net pay. Okay, so what we just did is we added to an expense with a debit that increases expenses, and we also subtracted that from the checking account because it's going to be paid to the employee and deducted from the checking account, and we subtract from checking with a credit. So now at this point, this is what the entry looks like. I'm going to go ahead and save this and go to the next example. In the next example, I'm going to assume that the company pays their health insurance for the company through their payroll processing service. So this is an option for companies. There are payroll services out there that do a full service type of thing where they process payroll and they deal with the tax forms and tax payments, and they offer a group health insurance plan. And I want to show you how it would look in a journal entry for payroll. So I already have a credit to insurance group medical, and this is an expense account. And this is from, let me pull back up my PDF of the actual entry. So where that came from is right here. You can see each employee had a deduction for medical insurance. So each employee is contributing $100 for their medical insurance cost, and that's a total of $304.50. If the employee is contributing towards health insurance, that reduces the company expense for health insurance. So that's where I got the credit from the last video. But now I want to talk about how you would treat it if the company paid the group health insurance plan through the payroll processing service. It's going to be an additional cost that they pay to that company, to that payroll processing company. So that is going to be an expense of the business if they're paying it. So what you would do is add a line item for your group medical insurance. And let's just say they pay $1,000 per payroll for group medical insurance. So the company pays $1,000, but the employees contribute $304 towards that cost. So for the company portion, that's an expense of the business. That is going to be a debit. But then you subtract by doing the opposite. The credit is the opposite of a debit, and they subtract from each other. Now you don't have to do two line items. You could net these together and have one line item with a debit for what, $695.50. Let me see if I did my math right. $695.50. So you could just take that out and have this be $695.50, which would be the net of the employer payment minus the employee deductions. But when I do these entries personally, I like to separate what the employee pays versus what the employer pays. I like to just see it separately when I'm going through entries. So I would probably leave it as two separate line items, but it's really up to you. Either way would be correct, as long as the net expense is the $695.50. Okay, I'm actually going to cancel this and come back into the entry so that I can do it the way it was originally stated. Okay, so I am going to just keep it as this with the $1,000 debit and the $304 credit. Now, if the company is paying the health insurance through the payroll processing service, then that also is going to change how much that payroll processing service deducts from their checking account. So that's going to also change the payment for taxes and withholdings and expenses. So that is going to add another $1,000 here. So I'm going to go ahead and save this and move to the next example. And then I'm going to do one more example. I'm gonna do an example of this company paying a contractor for contract work. Sometimes companies pay contractors through their payroll service. It can be a convenience thing because sometimes the payroll service will deal with the 1099s at year end if you're doing the contractor payments through their system. So it varies. There's different payroll processing services that offer different options, but if they do offer that 1099 thing, then that can make life easier for the company. Okay, so we're going to do an example of them paying a contractor $800. Now, some payroll processing services will deduct that expense separately from the checking account. Instead of doing one lump sum for the salaries, owner draws, and contractors, it will do a separate line item on your bank statement. So if that is the case, you would simply add an expense for that contractor payment. So let's just say the contractor's paid $800. You would add an expense from the checking account for that $800, and you would post it to your contractor's expense account. So in that case, it would basically be treated like any other expense you have in your business. But since this video is related to payroll journal entries, I'm going to show you how it would look if it was included with that payroll amount that was deducted from the checking account and included with all the other wages. Okay, so I'm going to cancel this and delete that 0 line item that Wave likes to create. And I'm going to go back into that original journal entry. Okay, so all I would have to do is add a line item for the contractor expense. So we're adding to an expense with a debit. And then that would also be deducted from the checking account along with all the other payments for salaries, owner draw, and all those types of things. So right now, I showed before $8,400 was being deducted from checking, but now there's going to be another $800 being deducted from checking. So that's going to change this to $9,200. Okay, so that is what your journal entry would look like at this point. I'm going to go ahead and save this, and we're going to go look at the reports so we can see how all of this played out on the reports. Okay, first we're going to look at the profit and loss, which is also called an income statement. So any expenses of the business are going to show up on this report, and we had several. There was a bonus paid to employees of $1,000. Contractors, I'm going to click on that so you can see the information. There was an $800 payment in this payroll for contractors. There was insurance disability in that example situation. I talked about this in the first video where the company paid insurance of $120, but then the employees had $73.15 deducted from their pay to contribute part of the cost. So the net cost to the business is going to be the $46 difference. And then insurance. In the first video, I did an example where they paid Blue Cross Blue Shield for health insurance, but then in this video, we just made it as part of the payroll. And then you would subtract or credit for any employee contributions towards that cost. So the net would be the difference between what the employer paid minus the employee contributions. And then there was office supplies, that was in the previous video. This was simply a reimbursement. And then there were some retirement plan contributions that the employer made on behalf of the employees. That is an expense of the business. This is not the employee contributions, this is the employer match. And then I showed payroll employer taxes, which would be your FICA taxes, unemployment taxes, and things like that. And then of course, gross wages would be salary and wages. And then we had workers' comp insurance of $75. So all of those were expenses this subtract from income, and then that's going to equal your net profit or net loss. Okay, let's go to the balance sheet and see what that looks like. Most of the transactions we went over affected the checking account. So if I drill down to that, I can see that there's several payroll related transactions there. And then we also did something related to garnishments. In the last video, I showed the garnishment owed and then the garnishment paid, and those two entries zeroed each other out, so it's not going to show up here. And then of course we have the owner drawings, which was the $2,000 owner draw payment. Hopefully this was helpful. If you have any questions, feel free to comment below, and otherwise, thank you for watching.